Hi, welcome to our financial management course. Today, we are learning about dividend signaling theory. This concept helps explain why firms pay dividends and what those dividends communicate to investors. At first, dividends may seem straightforward. A firm earns profits and distributes part of those profits to shareholders. But in financial markets, dividends carry deeper meaning. They are not just payments, they are signals. To understand this, we need to start with a key concept: information asymmetry. Information asymmetry exists when managers have more information about the firm than investors. Managers understand future cash flows, internal operations, and upcoming opportunities. Investors do not have direct access to this information. Instead, they rely on observable actions. Because of this gap, investors cannot perfectly value the firm. They must interpret signals to form expectations about the future. This is where dividend policy becomes important. When a firm changes its dividend, investors pay close attention. They ask, why did the firm increase dividends? Why did it decrease them? What does this tell us about future performance? Dividend signaling theory tells us that these changes are not random. They are intentional signals sent by managers. Signals about future earnings. Signals about financial strength. So, the key idea to remember is this: dividends are not just cash distributions. They are a form of communication between managers and investors. We will explore how dividend increases and decreases send different signals to the market. Now that we understand information asymmetry, let's explore the core idea of dividend signaling. The central insight is simple but powerful. Changes in dividends convey information about a firm's future earnings. Let's start with dividend increases. When a firm increases its dividend, investors interpret this as a positive signal. It suggests that managers expect strong and stable future cash flows. Why? Because increasing dividends is a commitment. Once a firm raises its dividend, investors expect that higher level to be maintained. If the firm cannot sustain it, the consequences can be severe. So managers will only increase dividends when they are confident in the firm's future performance. Now let's consider the opposite case: a dividend decrease. When a firm cuts its dividend, investors usually interpret this as a negative signal. It may indicate declining earnings. It may suggest financial uncertainty, or it could reflect concerns about future cash flows. As a result, dividend cuts are often followed by negative market reactions. So, we can summarize this clearly. Dividend increases signal strength. Dividend decreases signal weakness. But here is an important point. These signals are credible because they are costly. Firms cannot easily change dividends without consequences. This is what makes dividend signaling effective. Managers are not just talking, they are committing, and investors listen very carefully to these commitments. Now we understand that dividend changes send signals. But an important question remains. Why do investors believe these signals? What makes them credible? For a signal to be effective, it must be costly to imitate. In other words, weak firms should not be able to easily pretend to be strong firms. Dividends satisfy this condition. Let's see why. First, paying dividends reduces the firm's internal funds. When a company distributes cash to shareholders, it has less money available for investment. This creates a real financial cost. Second, firms may need to raise external financing to support dividend payments. External financing is not free. It involves transaction costs. It may involve issuing debt or equity under less favorable conditions. So again, there is a cost. Third, and perhaps most importantly, dividend cuts are heavily punished by the market. If a firm increases its dividend and later reduces it, investors react negatively. Stock prices often fall. The firm's credibility is damaged. Because of these costs, dividend policy becomes a reliable signal. Only firms with strong and stable future cash flows can afford to maintain high dividends. Weak firms face a problem. If they try to imitate strong firms by increasing dividends, they may not be able to sustain those payments. Eventually, they will be forced to cut dividends, and that leads to negative consequences. So they choose not to imitate. This creates what we call credibility. Managers are not just sending signals. They are backing those signals with costly commitments. Now, let's take the idea of signaling one step further. We introduce the concept of a separating equilibrium. This is a key idea in understanding how dividend signaling works in practice. Imagine there are two types of firms: high-quality firms and low-quality firms. High-quality firms have strong and stable future earnings. Low-quality firms have weak or uncertain future earnings. Managers know which type their firm is, but investors do not. This is the core of information asymmetry. Now, the question is, how can investors distinguish between these two types of firms? The answer lies in dividend policy. In a separating equilibrium, the two types of firms choose different actions. High-quality firms choose higher dividends. Low-quality firms choose lower dividends. Why does this separation occur? Because high-quality firms can afford to pay high dividends. They have strong future cash flows. They can sustain those payments over time. Low-quality firms face a constraint. If they try to mimic high-quality firms by paying high dividends, they run into problems. They may not generate enough cash flow. They may need costly external financing. And eventually, they may be forced to cut dividends. That dividend cut would send a negative signal to the market. So low-quality firms choose not to imitate. They reveal their type through lower dividend payments. As a result, investors can infer information. They begin to distinguish strong firms from weak ones based on dividend behavior. This is the essence of a separating equilibrium. Different types of firms choose different strategies, and those choices reveal private information to the market. Now let's look at how firms behave in practice when setting dividends. In reality, firms do not frequently make large or abrupt changes to dividends. Instead, they follow a policy known as dividend smoothing. Dividend smoothing means that firms adjust dividends gradually over time. They avoid sharp increases, they avoid sudden decreases, and they aim to maintain a stable pattern of payments. Why do firms behave this way? The answer is directly connected to signaling. Remember, dividends are interpreted as signals about future earnings. If firms change dividends too often, they risk sending confusing or misleading signals. Investors may begin to question the reliability of those signals. So managers act cautiously. They do not increase dividends unless they are confident that the higher level can be sustained. This is very important. A dividend increase is not just about current performance. It reflects expectations about long-term financial strength. Once a dividend is increased, managers are reluctant to reduce it because a dividend cut sends a strong negative signal to the market. As a result, firms prefer stability. They prefer gradual adjustments. They prefer to smooth dividends over time. This behavior helps maintain credibility. It ensures that when a dividend change does occur, investors take it seriously. So dividend smoothing is not just a mechanical policy. It is a strategic decision, a decision designed to protect the firm's reputation and the credibility of its signals. Now let's examine how financial markets respond to dividend changes. So far, we have discussed dividends as signals. But do investors actually react to these signals? The answer is yes, and the reactions are often immediate and significant. When a firm announces a dividend increase, the market typically responds positively. Stock prices tend to rise. Why does this happen? Because investors interpret the increase as a signal of strong future earnings. They update their expectations. They become more optimistic about the firm's prospects. As a result, they are willing to pay more for the stock. Now consider the opposite case, a dividend decrease. When a firm cuts its dividend, the market reaction is usually negative. Stock prices tend to fall. Investors interpret the cut as a warning sign. It may suggest declining profitability. It may indicate financial distress, or it may signal uncertainty about future cash flows. So investors revise their expectations downward. This leads to selling pressure in the market. These reactions are not random. They are based on the information content of dividends. Dividends are not just cash flows. They are information events. When a dividend is announced or changed, investors treat it as new information about the firm. They process that information quickly, and they adjust prices accordingly. This is why dividend announcements receive so much attention in financial markets. They play a key role in shaping investor beliefs and firm valuation. So far, Dividend signaling theory provides a strong explanation for why firms pay dividends. But like all financial theories, it has limitations. It does not fully explain every aspect of dividend policy. Let's examine some of these limitations. First, taxes. In many cases, dividends are taxed more heavily than capital gains. This makes dividends less attractive to some investors. If investors prefer capital gains, then dividend payments may not always be the best signaling tool. Second, investor preferences. Not all investors want the same thing. Some prefer steady income through dividends. Others prefer firms to reinvest earnings for growth. This is known as the clientele effect. Because of these differing preferences, dividend policy may reflect investor demand rather than signaling alone. Third, alternative signals. Dividends are not the only way firms communicate information. Firms also release earnings reports. They make investment announcements. In many cases, these signals may be more direct or more informative than dividends. Another important point is the rise of share repurchases. Instead of paying dividends, many firms now return cash through stock buybacks. Repurchases can also act as signals, and in some situations, they may be more flexible than dividends. So while dividend signaling theory is powerful, it is not complete. It explains an important part of corporate behavior, but it must be considered alongside other factors. Understanding these limitations helps us develop a more realistic view of how firms actually make financial decisions. Let's conclude by bringing everything together. Dividend signaling theory provides a powerful framework for understanding dividend policy in real-world financial markets. At its core, the theory is built on information asymmetry. Managers have better information about the firm's future than investors. Because of this, investors rely on observable actions to form expectations. Dividends are one of the most important of these actions. We learned that changes in dividends convey information. An increase in dividends signals confidence in strong and stable future cash flows. A decrease in dividends signals potential weakness or uncertainty. These signals are credible because they are costly. Firms cannot easily increase dividends without committing to sustained payments, and cutting dividends leads to negative market reactions. We also explored the idea of separating equilibrium. High-quality firms choose higher dividends. This allows investors to distinguish between firms based on their dividend behavior. In practice, firms follow dividend smoothing. They adjust dividends gradually. They avoid frequent changes, and they are cautious about making increases they cannot sustain. We also saw that markets respond strongly to dividend announcements. Stock prices rise with dividend increases, and they fall with dividend decreases. This reflects the information content of dividends. Finally, we discussed the limitations of the theory. Taxes, investor preferences, alternative signals, and share repurchases all play important roles. So dividend signaling is not the full story, but it is a critical part of how financial markets interpret corporate decisions. The key takeaway is simple. Dividends are not just payments, they are messages, and understanding those messages helps us better understand firm value and investor behavior. Thank you for joining this lecture. I will see you in the next one.